Damian Cullen with my August news update. Firstly, let's go to global markets. We've actually seen a pretty good period in global economies. The US is continuing to do very well. China seems to be avoiding the hard landing that people were worried about. The surprise area has probably been the European economy, which everyone thought was a basket case, but has actually been posting some pretty good numbers in the last 12 months or so. So it's been good. Even traditionally slow economies like Japan are doing quite well. So we're seeing a period where we're getting a bit of consolidated global growth coming through, which is a nice little sweet spot to be in. Hasn't happened for quite a few years now, so things are actually looking reasonably good. That's translated through to reasonably good market performance and return on investment. So share markets have done quite well, particularly the US and Europe. And even the Australian economy has also done pretty well. So we've been rewarded with some fairly nice returns in those spaces. And as things look at the moment, there are really no great concerns or things to worry about. So I'm reasonably confident that we should potentially have a good period again for the next 12 months if nothing major changes. I probably would like to just express my concerns with housing prices, particularly in the major capital cities, Sydney, Melbourne. I just cannot see any great returns coming out of those markets. I'm concerned about how far prices have run. They've had a fantastic period for about the last 10 years, and really everything that could go right for housing has gone right. It's likely that we're going to see higher interest rates at some point in the future, and if those rates go up considerably, then I think we're going to see a lot of pain in that sector. So I'd be very cautious about making any major purchases in the near future in Sydney housing or Melbourne housing. From a superannuation point of view, the changes that were announced in last year's budget have now been implemented by the government. They came into force on the 1st of July this year. The major changes that you need to be aware of there are that there's now a cap of $25,000 that can be contributed into super every year, and that includes whatever your employer's putting in. So if you have been contributing money to super, you've just got to be very careful that both yours and your employer's contributions are not exceeding that new $25,000 cap. That's come down from $35,000 or $30,000, so it is a lower amount. The government's also reduced their lump sum contribution amount from $180,000 to $100,000. So across the board, they're making it harder to get money into super. That's largely because super is still a great tax-effective vehicle, and they're trying to limit the amount of cost there is to the budget to try and repair the budget balance sheet. So not ideal. I probably don't really agree with the way they're going about doing that. I think they should be trying to get as much money as they can into super to fund the ageing population, but political arguments are for another day, I guess. There is a $1.6 million cap on tax-free pension payments now. So if you do have a larger pension balance, that's something that you need to consider. You can have more than that in super, but the 1.6 is the maximum amount you can get tax-free. That's about it for this update. I look forward to speaking to you in the near future.